Hello everyone. In this session, I'll be talking about market and funding liquidity and overview of that based on an article that has been suggested for FRM Part 2 2017 exams by Garth in the current issues segment. So the topic that I'm covering is purely based on the aim statements that are specified for that exam. So you can very well read through the article, which is available for people who are taking the exam, and you can very well refer to this video, which can give you an overview of the various aim statements that have been provided, and the major reading of that article is very much recommended. So as a part of the topic, as a part of the aim statement, these are some of the important things that we are going to discuss today. I want to differentiate between what is market liquidity and funding liquidity. How do I really differentiate between the two? What are the various factors that are impacting the market liquidity as well as funding liquidity? Right, here we want to differentiate between the regulatory aspects versus the non-regulatory aspects which are impacting the liquidity. So the majorly liquidity is a main concern of this particular article. And we are also talking about what are the various links that are existing between the market liquidity and funding liquidity. And again, the link between funding liquidity versus the capital requirements that are associated with the banks and financial institutions. So this is the agenda for this session. So when I have to talk about market liquidity, I am focusing on the cost, both in terms of expense as well as time. Basically, how much time I am taking to sell my asset for cash. So if I'm literally able to sell out my asset immediately for the cash, for the price at which I wanted to sell, it means the liquidity in the market is high. But if I'm facing more and more of difficulties in terms of selling my asset, it's taking too long for the asset to be sold, and it's not giving me the price that I wanted when I wanted to sell it. I have to compromise on the price before I'm selling that particular asset. So those are the situations where the liquidity is very low in the market. So what is the cost? What is the kind of impact I have in terms of selling the asset immediately for the price without any kind of compromise or without any kind of lowering down of the price? If I am able to do that, then I say the market is liquid. But if any of these things are getting violated, means I am not able to sell it immediately when I want. I have to wait for few days. Even if I am waiting for few days, I may not be able to sell it at the price I want. I have to go for a compromised price. In all these cases, the market liquidity is getting affected. But coming to the funding liquidity, it's more to do with raising funds. So we talk about any financial entity or an institution. What is the level of ease that this financial institution is having in terms of raising capital? Right? How comfortable? What is the ease at which the financial institution is able to borrow, either on a secured basis or on an unsecured basis, whatever is the basis, but what is the ease at which the financial institution is able to borrow? If it is able to borrow quite quickly, then we say the market is very liquid. But if there is a huge difficulty for the financial institution to borrow, That is creating a situation of funding illiquidity. So though we can treat these two things as different, they have some levels of association between them as well. That is where we were looking about the linkage between the funding liquidity and market liquidity. Look at this scenario. Funding liquidity is declining, means I'm not able to raise new funds in the market. I'm not able to raise capital. Let's say because of market stress. Right? The market is very stressed, and because of which no bank is lending. So I'm not able to raise new capital in the market. Now that itself is causing the intermediaries to become less willing to provide market liquidity also, because now they are not ready to buy assets, sell assets. So there is a very good chance that if the funding liquidity is declining, means I am not able to raise funds. Obvious that I don't have money to buy something. So when someone is trying to sell an asset, I would not be in a position to buy it. So even the market illiquidity can very well arise as a consequence of funding illiquidity. Now the same logic, you look at it the other way. The market liquidity is going down, means people are not able to sell their asset at the price and time they want. So because I am not able to sell my asset, so people who are lending, they may not take those assets as collaterals. So because they cannot take them as collaterals, even the funding liquidity is getting badly impacted. So the whole system is becoming cyclic, which is impacting the overall liquidity of the process. And even if there is funding liquidity deterioration, means people are not able to raise funds. So the whole financial system is getting very stressed up. And people are not able to sell their assets also. They have the asset, but they are not able to sell it to raise the fund. So market is becoming illiquid, funding illiquidity is occurring. So because the market values of the assets have gone down quite drastically, so they are not able to sell their assets, or even if they are selling their assets, they are forced to sell it at much lesser prices, and because of it the solvency of the firms is getting very badly challenged. So keeping the liquidity to a reasonable level both on the market front and a funding front is very essential part of any financial system. Now when we are talking about the various factors that are impacting this liquidity, one, transaction expense, brokerage costs. If the brokerage costs are very high, people will not be able to sell their assets frequently, right, or buy their assets. So if the brokerage is very high, obviously the transactions will go down. Only if the brokerage is very narrow, more number of transactions, voluminous transactions can very well be facilitated. So the more the brokerage, the lesser the number of transactions. So we could see that as something that is impacting the liquidity. And now we have already seen that one is impacting the other. So if at least one liquidity is getting impacted, we see the chain reaction of how it can impact the other liquidity, and the overall liquidity is getting stressed up. Now the price the transaction is executed is at relative to the midpoint of the bid ask. Now let's say this is the bid, this is the ask. Now to what extent the price at which the transaction is executed is somewhere here. Is it more toward this side or is it more towards this side? Now the more and more closer it is towards the midpoint, I can expect a lot of liquidity occurring. Whereas if it is more close to the bid, so there are more number of people. So now if the transaction is executed more and more closer to the bid price is the price at which the financial institution, the dealer, is buying, And if more of the transactions are happening at this itself, I could see that the selling is a very difficult process, and the vice versa. So the more and more closer the transaction is executed at a point relative to the midpoint of these two, the more is the association to the liquidity I can give. Now that is one more factor that is driving the liquidity. To what extent one single transaction, right, can it first of all really move the market price? And if at all it is able to move the market price, to what extent the market price is getting affected because of one single transaction? So that is also another important measure that can impact the liquidity of the market. The speed at which the transaction gets executed, the faster it is, the more liquid it is. Immediacy. So the more immediate the transaction is executed, the more liquid I can associate that particular transaction. And if it is not getting executed at a quicker speed, then I can very well say that that particular asset is more illiquid market. So during the financial crisis, there are so many financial institutions that went out of the business, and the main reason why they had to shut down their businesses, why they have typically gone bankrupt, is they were not in a position to finance their long dated illiquid assets. They were not able to raise the capital against the various assets that they had. Whether you look at metal gesell shaft, they had huge number of assets, but there is a lot of liquidity issue, even to the extent of Lehman Brothers. When they had typically gone bankrupt, they were not, it's majorly the illiquidity related activities that has really taken them towards the bankruptcy part. So they have long dated illiquid assets which could not be funded, and that is what resulted in their closing down of their operation. So it is very essential that the organizations give more importance to handling this market and funding liquidity aspects. Now, the other dimension of looking at these factors which are impacting the liquidity is one from a regulatory dimension and one from a non-regulatory. On the regulatory aspect, if you look at the liquidity during the crisis or over the past few years, there is a very big decline in the liquidity purely because of the high regulatory burden that is coming on various security firms. So the regulator is, so there are again positives and negatives of it. Regulator is intervening very heavily on the security firms, because of which the liquidity aspects got considerably reduced for many security based firms. They have increased the capital requirements and the liquidity related requirements. Even if you see, there are so many revisions that have happened to the Basel framework as well, bringing in the capital and liquidity requirement for largest security dealers, even for too big to fail kind of firms also came under the purview very heavily to capital and liquidity requirements. They have adversely impacted market liquidity, but at the same time, it's a process of risk management altogether. So the whole thing is affected. So whole transactions have affected the profitability of the dealer intermediation. So all kinds where intermediaries are involved, they had serious setbacks on their profitability, and even that has affected the provision of market liquidity as well. The markets became very illiquid because of all these regulatory interventions. Even the supplementary leverage ratio, which we call as SLR, that is limiting the leverage of the dealer's balance sheet. So earlier the leverage there were not much of restrictions associated with the leverage, but now there is a limitation to the usage of leverage. Again, it's a risk management activity. So here we see all the assets are treated in the same terms of regulatory capital. So which means the low risk assets as well as high risk assets, they are all treated the same terms of the regulatory risk capital. So that way there could be a tougher job for the low risky assets, because if they are having low risk, the capital requirement should be logically lower for them, and high risky assets should carry high amount of capital and liquidity requirements. So again, as I already pointed out, Basel has been continuously getting revised. So the risk weighted capital ratio typically increased from the Basel requirement perspective. Even there is a comprehensive capital and analysis review, CCAR. There are stress tests. So all these things, they have put so many limitations on the proprietary trading part for good number of asset classes, which has affected the market liquidity to the core. Now there should be now other alternative ways of seeing how the market liquidity can be improved, but at the same time there cannot be a compromise on the risk management aspects, where we can see one more crisis cropping up because of non-regulation of all these various activities. Now coming to the non-regulatory factors that have been impacting the liquidity. So the liquidity is very much affected by the changes in the market structure of the firms and how the trades are executed, what kind of trades are executed, how the trades are executed, and even from the competition from those companies which are operating outside the regulatory boundaries, which are not coming under the regulation. They are competing with the firms which are coming under the regulation. So this is also one more important aspect from a non-regulatory perspective that is impacting the liquidity. So the demand for liquidity, one, because of good number of large asset managers coming up. So there are huge number of funds that are doing buying and selling processes. So there is a need for liquidity that is growing by leaps and bounds. There are huge number of mutual funds coming up, exchange traded funds coming up, principal trading firms coming up, high frequency trading firms are there, because of which there is a huge demand for liquidity. And in the credit market, we see a rapidly rising share of corporate bonds. Now a huge number of corporate bonds are getting issued, and they are being held by mutual funds. So the majority, there is a good proportion of mutual funds that are holding the corporate bonds as a part of their portfolio. And the rapid growth may have contributed to the declining in the secondary market trading market activity, because mutual funds have been holding these assets. So the secondary market trading activity also has gradually declined, even thus contributing to the decline in the liquidity aspect. And looking at the link between the market and funding liquidity, some of these we have already discussed. So if firms that trade and invest in securities, look at those firms that are trading in various securities, that are investing in various securities, if they are not able to raise funds, means they cannot raise capital to buy or sell. So the overall transactions are going down, the volume of the transactions is going down. So overall the markets are becoming thinner. Market is becoming thinner itself means the market liquidity is also going worse. So an inability to raise capital means I cannot do margin buys or sells, right? I cannot keep something as a collateral to raise funds. All these kinds of borrowings are getting badly affected. Majority of the people do the trading by doing these kind of borrowing. So if I am not able to raise additional capital, obviously the trades are becoming lesser, markets are becoming thinner, and overall market liquidity is also getting affected. Now if there is no good source of short-term funding, the whole functioning of the market is becoming impacted. So the overall funding and market liquidity is getting further badly affected. Now if there is no funding, think of all these players who are very heavily leveraged. Their main business is based on leverage financing itself. They raise the capital through borrowing, use that for buying, and then sell the proceeds, pay back. So where you see this kind of a process like hedge funds, which are heavily dependent on the leverage, but now if the funding is not available, obviously the hedge fund is going to get a big jolt. So they cannot typically react to the various dislocations that are there in the market price. They cannot take advantage of the market price. They cannot get into an arbitrage because arbitrage requires huge capital. They are going long on one and short on the other. So wherever they are going short, there may be a lot of margin requirements for those asset classes which they are borrowing. So there is a very heavy necessity for the leverage players to have good access to funding. So they cannot really get into an arbitrage activity where they are typically buying the cheaper one and going short on the expensive one. So that cannot be done to the fullest as well. So all these factors could really impact the market and the funding liquidity, and probably both of them are very much interconnected because of these various reasons. And coming to the various links that exist between funding liquidity and capital requirement, the more and more stronger the capital requirement is, very rare that I can expect that there will be a bank run. So there is a lot of stability to the banking system. There is a lot of stability to the financial institution. Very small probability that there will be a run on the financial system. So more and more stronger the capital requirement is, the more stability is the functioning of that particular financial institution. And the capital requirements can be bolstered to typically reduce the risk that the firm will become insolvent. Very small, limited chances that the firm will become insolvent, the more is the capital requirement. Even if the economy is pretty bad, even if the markets are not doing good, there is a very limited chance that the firm will go bankrupt if the capital requirements are very stringent. And if the reporting and the transparency part is improved, and so which means lots and lots of uncertainty are removed from the transaction processes, and which means overall the chances of the firm remaining solvent are increased drastically. And the liquidity requirements can be increased primarily to reduce the risk that the firm will engage in fire sale. If the liquidity is very poor, if there is huge market illiquidity for a particular firm, it may not be able to sell it as assets at the market price. It has to compromise on the price. It has to get into fire sales, compromise on the price at which it wants to sell the asset, and probably end up selling up the asset at a much lower price than what it expects to be sold at. And that itself could contribute to depletion of the capital quite drastically. So that's where the funding requirements, the capital requirements really play a major role in the liquidity of the firm. And if the firm is having a liquidity buffer, even if a bad event is coming up, the management can really think, they can take their own time to respond to this bad event. They really don't need to get into the process of fire selling at a much lower than the market price. And at the same time, the central bank that is acting as a lender of last resort, even that can provide kind of a liquidity backstop. Even in those cases, the funding liquidity is becoming very, very resilient. If this central bank does not act as a lender of last resort, you see that all the kinds of banks and financial institutions, they go into an unwilling to lend kind of a mode, because they typically keep on perceiving that the counterparty could be insolvent, and they want to protect themselves. They don't want to go insolvent because they are dealing with a specific counterparty. So they would always be worried about what the other banks are typically thinking. So because of this, the whole liquidity gets challenged. So even the concept of lender of last resort role that is played by the central banks is also a key aspect of promoting the funding liquidity within the financial institution. So these are all these various topics that I wanted to cover as a part of this session. I strongly suggest that you read through the article as well to cover some of these minor aspects of the whole article, which are not being a part of the end statement specified by GARD, to get a complete view of the article. Regarding these topics that I have discussed, if you have any further queries, you can very well get in touch with me by giving me a call on the number that I have given below, or you can even send in an email at vamsidhar@pagegurus.com. Thanks a lot for listening to this session. Thank you very much.